Well, welcome everybody on this beautiful Sunday to Biz for Christ. I think next meeting, if this keeps up, we're going to have standing room only. So we're going to have to get here early. My name is Tom Skank. I want to introduce you to Brad Boswell, who's going to be talking to us about long-term care. And also, kind of all related to that, we've got Brian over here. Raise your hand, please, Brian. Who is a financial expert who dovetails in with all different types of financial planning. And also we've got a plug going out for a fundraiser. Would you please stand and tell us about that, please? Just 15 seconds.
Why not make it even 20?
Why not? There we go.
So I made this announcement about the fundraiser a couple weeks ago, and it's been going on for a few weeks. Today's the actual day at Surf Rider Pizza in La Mesa. So if any of you like Surf Rider Pizza, it's owned by the same owners as the Corvette Diner. 15% goes to the nonprofit.
Yay! Thank you very much. And it's an incredible nonprofit as well. So please, if you've got some time, go out and support them. Let's bow our heads, please. Dear Lord, thank you for your kindness in allowing us to be here together in fellowship. And may we all have a safe rest of the day. Thank you very much. Amen. It's all yours.
Mike, okay. Welcome, everybody. I'm Brad Boswell. I'm a member of Skyline Church. Recently became a member last November. I was actually raised in the Skyline community. I went out, I was a long-time attender out at Lakeside Western Church. I grew up out there at Lakeside. When I graduated from UCLA, I came back to Skyline in the 80s with John Maxwell. Knew Ken Brown, Art Brown, some of the old standbys are here, Barking Beats, some of those folks. And then I was away for a while at different churches. We came back the first Sunday in June of last year. Happy to be back. This is my home. Right. So I went to the membership in November. We're going through the core classes right now. It's been exciting. Being in touch with Skyline. I'm very happy to be here. I'm going to talk today about long-term care insurance. I've been a long-term care solution specialist for 28 years. Anybody here have ever gone through the topic, ever did any reading on the topic? How many people are familiar with the topic? Show of hands. So much familiar? Okay. You have a number of people in here with coverage? People? Good, good. So we're going to touch on some of the things that are in the plan, how these things work mechanically. And you might want to look at your own life and see if something like this might make sense. Okay. I've got a little tool here that breaks it all down. I used to do this with people. Now I do a lot of this on the internet. Doing that since about 2010 on the internet. I don't go out and do many home appointments anymore. But this is a little tool to help you understand things. The 1996 law that was signed by President Bill Clinton set up national standards for long-term care. All the companies do the same thing. They're all mandated. Okay. There's no differences amongst the companies. Premiums may differ, there may be some additional riders that may differ, but the core of the policy is the same. They're all the same. Okay, they're mandated. And so when you look at this tool here, you start to look at some of the levels of care in the plan. Now, some of you are probably aware that Medicare covers a minimal amount of care in a skilled nursing facility. We call that the 5th level of care. But you got to look at what's inside the long-term care as well. We've got the intermediate care, we've got the custodial care listed there. So the long-term care covers home health care, whether it be home care aides or certified nursing. Then they cover adult daycare. That's where you go just for the day for lunch and snacks with socialized group. And it gives the spouse who may be healthy at home a break as well. Then you've got 3 different venues for care. You've got the group home, which is a part of the assisted living, where you're receiving this custodial care, which is help with the activities of daily living, which I'll touch on in a moment. And that tends to be a 6-bed facility, 6 patients with 1 caregiver. The 4th venue would be your assisted living, which is typically a 12 to 50 bed. They've got to have 3 or more caregivers to have a lot more amenities. And then number 5 would be a skilled nursing facility, what we call a SNF. The initials are SNF. Maybe you've heard of SNF before. So those are the 5 levels of care in the plan. They all do the same thing. And then you start looking at some of the other things that are in there. Everybody has hospice care. That would be for 6 months. Well, let's say you go through your hospice care under Medicare. You're over 65 and you burn through your hospice. The long-term care policies also have that hospice for 6 months. That's mandated, all right? And so you start looking at what's available, and I have there in the skilled nursing facility, you've got your 20 days picked up from day 1 to day 20 for free because you paid into Medicare through your FICA tax. Some of you might be familiar with the FICA tax. Some goes to Social Security, some goes to Medicare. But after the 20 days are up, Medicare could cut you off. Why would they cut you off? Because on day 21, the care has to be skilled in nature. You have to be IV, catheterized, feeding tube, heart monitor. If the kind of care you need is help with the activities of daily living that we take for granted, like bathing, dressing, toileting, Medicare does not pay for custodial care. That's where people live in the hard way. So they get into the 20 days, that's it, and all of a sudden they get presented the bill. They're in a skilled nursing facility, all of a sudden it's 10 or 11,000 a month. They don't have coverage. Then you run the risk of burning through your assets and you have to Medi-Cal. So we try to provide those funds available for people to have that level of coverage, so they don't have to go into their nest egg and go into Medi-Cal. There's benefit triggers in these plans. You see it listed here. Those are the 6 activities of daily living. Okay. Hello? Better? And you've got the 6 activities of daily living. That's established by the federal law that was signed in '96. If you need human assistance or standby help with 2 or more of those, that's one way to generate the benefits. The other way to generate the benefits would have cognitive impairment. You flunked a 20-minute memory test. So it's either or, either one of the 2 ways will work to get into the policy. Who signs the claim form is your doctor. And many policies will accept a nurse practitioner signature. So that'll generate the claim to get things moving along, okay? These plans allow you to choose your own home care givers. They allow you to choose your own facility. There's no network of any kind. And it's a really interesting thing how these things will work. Now, my parents had coverage. My dad got dementia. He had 5 concussions. He had a 6-year benefit of $6,000 a month. He burned through the whole $432,000. Luckily, we took some of his money and put it in the market between 210 and 220, and the estate still grew. But I mean, that's a big claim. How many people can self-fund for $432,000? How many people would like to use $432,000 of their own money? So it can be quite expensive hanging around with Alzheimer's, dementia, Parkinson's, what have you. Then you sort of look at some of the things that are available in the policy. There's a lot of different little riders you can put on there. You can grow the benefit with inflation riders like 3% or 5%. You can have the plan typically comes with a 90-day deductible. Some of them today allow you to pay down that deductible by buying a little rider and going down to a 0-day home care. Some companies offer that for an additional fee. Some of them offer a chance to link the policies together. If you got a husband and wife, you both have coverage, and one dies and doesn't use their benefits or only uses some of them, whatever they have left goes to the other spouse. So the deceased spouse premium goes away. Now the remaining spouse has a lot more benefit for the same amount of money. That's kind of nice. Also, if you get so sick and you go through your policy maximum, you can drag over the other spouse's benefits and double up. Allows you to make a financial decision. You might think, gee, we have a big thing in front of us. Why don't we take care of that with the insurance company's money? Honey, why don't you self-fund with the remaining part of the money I'm not going to use? Sometimes people can make that strategic decision. The thing to remember about the long-term care insurance when the law was passed in '96 is that first thing it did is it mandated those 5 levels of care. It set up the 2 ways to go on claim, the 2 benefit triggers, activities of daily living or cognitive impairment. But it also made it portable. So if you leave California, it's portable, it covers you in 50 states. That's a big deal. The next thing it did is the premiums can be tax deductible. You might be an S corp, you might be self-employed, you might be an LLC. It's tax deductible. And in all cases, the money comes out federal and state tax free. You don't pay any income tax and benefits. Now, if you start ripping through your own assets, selling a home, and maybe when the market's down, you got to pay capital gains or paying capital gains in the sale of stock. That's an expensive way to fund long-term care. The long-term care money comes out federal and state tax free. Some of the other things that are in there is people get asking this all the time. Can I ever be dropped? Some of you may have heard even recently in California, you're in an area that's a high fire zone. You might have lost your homeowner's insurance. Maybe you've lost your auto insurance. We can't drop you under the federal law. So whatever company you go with, you can drop them. They can't drop you. They can never take anything out of the policy. The 5 levels of care stay and the 2 benefit triggers stay. They can raise the premium, and that's the only thing they can do. They can never drop you. I mean, if you know any physicians, they come up for renewal every couple of years, they can lose their medical malpractice. This can't be dropped. That's a unique thing in the world of insurance. The other thing that you have to keep in mind is when you go to use the policy, whether it be at home or in a facility, that's called waiver of premium. The premium is waived when you're drawing the benefits. You don't pay anymore. You stop paying when you're using the policy. Okay, that's a unique thing. The other thing that's kind of unique about it is that when you're using the policy, you've got an inflation rider, the benefits are still growing even when you're using the policy. I've had people say, I got 5% and the pool of money was $400,000. And the following year, my pool of money still went up 20 grand. I said, yeah, it's still going when you're using it. I mean, have you ever heard of insurance that does that kind of thing? That's what goes on with these policies. So these are pretty universal. They all do the same thing. The big question for so many people is a lot of people can afford me, but they can't qualify. And there's the rub. Some people have pre-existing health issues and they can't qualify. And that's always the thing when I have to talk to them privately off the record and find out what's going on in your health to see if you're qualified or not. Because not everybody can qualify. The other thing to remember about these policies, when you start looking at some of the key little riders in here, a husband and wife have a policy. Some companies offer a plan where you have a survivorship. Not all of them offer all the riders. Some of them, they're available under the federal law, but not every company offers. One of them, the survivorship, says if you both have coverage, husband and wife, and nobody uses it for 10 years, you pay for 10 years, no one's used it for 10 years, you haven't died in 10 years. From the 11th year on, when the first spouse dies, the remaining spouse is free insurance, paid up insurance. Have you ever heard of paid up homeowners insurance, auto insurance? No, they have that in the long-term care market. So there's some pretty generous benefits here. Now, what's unique about this industry is a lot of people were fearful about buying it. It's called a use it or lose it situation. A lot of people don't want to put money in, thinking they may drop dead and not use it. Now, from where I come from, insurance is peace of mind. If you never use your homeowner's insurance, you never have a $100,000 claim, and you die, you feel happy. I didn't have to go through the headache of living in another house and going through a claim. Same with auto insurance. Anybody want a major auto claim? But for some people, it eat away at them. So about 25% of our market now is what we call hybrids. So the long-term care rides on top of a life insurance chassis. Okay, and we have a lot of companies that offer that. And it's going to cost more money because you got long-term care and life insurance together. And when you start to use the long-term care benefit, dollar for dollar, it does drag down the death benefit. So it's not one of these things where you get the death benefit and the long-term care. The long-term care will drag down the death benefit. But for people that might want to do a 1 pay or a 10 pay, you can do that. You just have to be prepared to pay more money. Now, if you do something like that in your 50s, it tends to be more cost effective. If you call me up at 67 and you want to do a hybrid, it can be quite expensive. So it just depends on what you're willing to spend for premium. But that's a new little thing in the marketplace as well. So those are the things that are going on in the industry. People have money growing their estate in their 401k, and something can come along and trip you up. So this is a financial planning tool, estate planning tool. Helps keep your estate intact. Does anybody have any questions or thoughts at this point? No? Any questions?
Brad, among your clients and among the people you've had contact with, what can you give an estimate of what percentage of people need long-term care at some point?
Well, when you look at this tool here, it says the percentage down the left-hand side. This was last updated. I saw the numbers in 2018. They put them out. About 1/2 of 1% of the claims are skilled nursing facility claims. Okay, 4.5% of the money is used for intermediate care. That means your Medicare is run out of your physical therapy or respiratory therapy visits. You can actually get into policy and use it for intermediate. But 95% of it's custodial care. That means they're at home or in assisted living of some kind. And you look at some of these claims now, they're going 3 and 4 years, 5 years, because people, when they have that initial medical thing hit, healthcare can hit it, knock it down, get you through a facility for a month or two. And now that item that might have been a 9 or 10 on a scale of 10 for health is down to a 2 or 3. Maybe you're having a little difficulty walking or the effects of a stroke, but you're still going on living. You need help to get through your day. It gets expensive. So you don't know how long you're going to linger for. The stroke is 43% of the claims, just so you know it. That's the number 1 claim in the industry, stroke. Alzheimer's, dementia, Parkinson's is about 11%. And then you've got people that have fallen. Like I have a sister who fell down a stairwell and got hurt in long-term we have a lot of people who've done an SSDI from workplace injuries. We have some of the biggest airline accounts. We have group insurance. You can't believe how bad some of these these baggage handlers get hurt. They can't go back to work. And so you'd be surprised what leads to claims. Motorcycle accidents, car accidents, snow skiing accidents, workplace injuries. You don't know what's going to lead to a claim, you know. But clients need this. I would say maybe 10% of the American public might be able to self-fund. I've got 25 or 30% towards the bottom of the socioeconomic that probably can't afford it. But the vast majority of the couples, 50 to 60% of them need to be looking at something like this, some kind of an alternative plan. Yes.
Well, not necessarily a question, but can you elaborate a little more on what you mean by group homes? Because there's a difference between Medicare funded group homes and then group homes where, you know, people with disabilities that are funded through San Diego Regional Center. So
Yeah.
there's a difference there between group homes. So
Yeah, I'm talking about more the Medicare ones. I'm in the long-term care industry. Most of them are set up for maybe memory unit only. I've seen 6 people go in there for strictly stroke. When you get to the bigger places, they have more flexibility to take multiple different types of people in there. But yeah, the 6-bed homes throughout the county, it might be $4,000 to $5,000 a month right now. Some of the bigger assisted living, they have an Ethan Allen look to them. Some of those places are $7,000 or $8,000 a month. Skilled nursing in this county, if it's semi-private right now, it's going to be $10,000 to $11,000 a month right now. So you start looking at that. If you go a couple of years and you're looking at $250,000, what kind of an impact would that have in your nest egg? I mean, yes, you have a question?
Yes, for a person like myself, I just turned 70 in December. Okay, today's the first time I've heard about this. What do you suggest?
Now, are you a Vietnam veteran? You have veterans benefits?
I am.
Then, well, we'll talk off the thing, but if somebody has a high Social Security disability with a VA and has a VA disability, now the VA has a capability, if it was service related, they may be able to give you 25 hours a week for 6 months for home care. And then they can find a VA home if we're in Chula Vista. So there's something like that might be available. So it just depends on your health. I have to ask people on the side because of HIPAA medical privacy, whether you can qualify or not. Now, this tool's got my phone number at the bottom. There's a color tool that we printed on. It gives you some of the more insight into long-term care, some of the little riders and what's in it. On the last page, you'll see my phone number there as well. So there's a couple things you can call to contact me. So there's my wife in the back. We're insurable. Hey, she's a sweetie. She's from Canada. They don't have long-term care in Canada. Yeah, this little tool is pretty helpful. This is what understanding the risk. But yeah, everything that we have in our industry is regulated. So when we get ready to do a claim, I don't have any fights on the claim. It's a clear-cut claim. The big fight is with the kids sometimes. What level of care do you want? We're going to pay for it, but some kids will have a difference of opinion. I want to go to this facility versus that one. I want to have this caregiver home versus that one. We went to a little bit of that in my family. Everybody has a different opinion about what needs to be done. The key thing is I've got the money to help you pay for it. I don't have the insight about what you guys want to do. So we'll get a case manager involved. In fact, let me dovetail into that. When you look at the 5 levels of care, there's 3 other little ancillary items. One of them is home modification. It may be $3,000, $4,000, $5,000 to have a contractor come out and put in the wheelchair ramps, railings, and grab bars, make your home accessible. The second thing is they'll have respite care. These are a dollar amount. It might be 21 days a year to give the caregivers a break, give them a break at home. And the final thing I like, we jokingly call that the concierge plan. Have you been on the vacation, gone down to the lobby to talk to the concierge? I'll tell you where to go lunch or dinner. Every one of these plans has built-in nursing case management. So when we get ready to do a claim, I have 13 states I handle. I have little teams. We do big group accounts. And I'll get a hold of a nursing case management team. They'll contact them. It's free of charge. The company you're with will contact them. They're not gatekeepers. They just help you. They can get the signature from your doctor. They can set up the billing. They can locate the caregivers. They can locate the facility. And then here's my favorite. They can mitigate spats, between family members, or if you're not happy with the level of care from your doctor, have this nurse with her 20-year experience throw her licensing on the table and let her get after the person for it. Say, this isn't meet the standards. Don't do it yourself. I used to tell my friends, my sisters and brothers, we got a problem at the nurse's station. Don't go out there. They might give our dad not good care. Let someone else do that. let them down gently. So that's built in there too. I don't like to get into things. We can give you the money. I can't make things work sometimes. If there's this going on, that doesn't work too well. But these plans are foolproof. They've had issues with rate increases. I'll address the rate increase issue. You got a question?
Yeah, Brad, you mentioned that the payments could be tax deductible.
Uh-huh.
Does that mean that an employer can pay for his employees?
I don't know about that, but if the employer is an S corp, the primary care, the employer can write that off. They don't have to cover their employees.
Well, that's what I'm thinking about, like a group insurance, that the health insurance, life insurance that the company can have for employees. I'm thinking it would be a great idea for an employer to have this offered to his employees at the heck of good benefits.
Yeah, what happens is when we do them, the employer will pick up 25%, they'll write it off. The employee can't, because if you're a W-2 employee, the only way you can get a tax break is if you have an HSA, health savings account. If you're a W-2 employee, it's not above line deduction at this point. But like I'm an S corp, I write it off. You know, different people, self-employed, I've got lots of realtors who are self-employed, they write it off. And so you can do those kind of things. The thing to remember is, in all cases, whether you write it off up front or not, the money comes out federal and state tax free. I mean, that 432 grand my dad took out, he would have had to liquidate over $500,000 from his 401k rollover to get 432 out of it.
Exactly.
That would have been expensive. Yes, you got a question?
What age would you recommend somebody look at this, whether it's the hybrid model? Is there a time where it's too early, or what's the cost benefit?
I have people looking at it at 45, but as other people say, the sweet spot, when you start to see the prices escalate, they start escalating right around age 63. So 50 to 62 is your sweet spot. You're going to do it. You're going to do your sweet spot. And then once you get a little bit older, you start to run in, just because of the aging process, medical conditions that render you uninsurable, you can't get it. You know, I'll give you an idea. We can take people with diabetes with good control on oral meds. But when you go into insulin, you can't take them. You'll be on oral meds. You can't have neuropathy in your feet or eyesight issues or kidney dialysis. I mean, the standard things that were rendered uninsurable would be, pre-existing would be Alzheimer's, dementia, Parkinson's. You've already had the major stroke, you're on the walker. If you've been on Social Security disability, SSDI, it's a knockout question. There's my little book I have on my desk. There's about 60 different conditions. If you got one of those, you're medically uninsurable. You can actually get cancer, stage 1, 2, or 3, and you've recovered from it. 2 years from stages 1 and 2, 5 years from 3. Now, if it comes back the second time, reoccurrence, it's very difficult to get long-term care on the second bout. That's tough. You know, the insurance industry is risk, and there's only so much risk they can absorb. You know, think about it this way: if you were an auto insurance company, you might charge a guy a little bit more on the first DUI. Would you accept his business on the second DUI? If you want that guy's business? I mean, think about it. I mean, this is not rocket science. There's only so much risk someone can take here. So, but the thing is, there's been some nice advances in VA healthcare. That's been a welcome addition. Given the home care, we got that going on. The rest of the people, if you've got a small group employer, and they want to contact me, we do that a lot, small group employers. We might want to provide employees coverage, kick in a little bit of it. Any other questions or thoughts? Okay, I got any questions?
Kind of a comment, but I'm in the same line of industry, but I sat with a client one time, and their long-term strategy was really their children. Honestly, they had no plan, right? The husband or wife. And a lot of times the kids don't see it coming. The adult kids don't see it coming.
That's right.
So it's important to have these conversations with your family. You know what I mean?
You know what the sad part is? So much of this was put on women in the past. And my sister is the third oldest, probably could have done it. And she had a workplace injury and she had some issues. And all of a sudden she can't be the caregiver. So my mom took care of her mother. They said, hey, we can't put this on all 6 kids. They bought the coverage. And it paid off in a big way for my dad. The things you don't think are going to lead to a claim. You got anybody that plays sports, a lot of football? Anybody know about that? I'll give you a funny story. Transamerica, one of our big carriers we do group with, got the NFL account. After 3 years, they dropped it. The claims over there from head injury, guys activating Alzheimer's claim at 55 and 60. That was going to be a piggy bank breaker. They couldn't do it. The claims were so high. I said, what happened to them? We lost the account. There's only so much risk you can take. Head injuries are a big part of it. Guys coming back from combat, they had concussion. that kind of thing, you'd be surprised what leads to dementia down the road at a very early age.
In some life insurance policies, you can borrow against the benefit. Is there flexibility in that? Where you can-
You can, if you have a hybrid, depends on how it's structured. There are some UL programs you can borrow against with a rider, and it reduces the death benefit. It just depends on what the product is. Traditional long-term care, which is about 70% of the industry, it's straight term insurance. You take the money out, you stop paying when you're sick. You don't borrow against it, you just take the money out. Some of the other ones, there might be a borrowing provision. But the thing about the hybrid you find interesting is there's two ways to qualify. So you might be able to get long-term care with a heart problem, because if you drop dead, don't use it, the insurance company doesn't pay a claim. You might be a little more relaxed there. But with life insurance out, you drop dead, there's a death benefit on there, 150, 200,000 bucks. They're less apt to want to take it. So when you do a hybrid, the underwriting is twofold. You got to qualify on the life insurance side, you got to qualify on the long-term care insurance side. And both sides are different, how they do things, how they pay off. One pays off when you die, the other one pays off when you linger. And they're trying to mitigate the lingering, that's what we do. Yes.
What about stents in the heart?
If there's good cardiac follow-up with a cardiologist, we're okay.
Because sometimes it's preventative.
Yeah, oh yeah, we've got a lot of people with stents. It's got to be 6 months with a good cardiac workup. The issue with AFib, if you got AFib and diabetes, that's the #1 combination for stroke. Atrial fibrillation with diabetes, that's a high risk. Now, the AFib can be controlled. We've had the ablation procedure. If we've had a heart ablation, we usually get them with the diabetes. But if the AFib is leading you to go to the emergency room once a year and your heart's out of rhythm, you got diabetes with it, that's a pretty tough case, So we're pretty good on that stuff. What really gets us in our industry is that people have the crippling arthritis. And a lot of companies will take someone up to having 2 joints replaced. They don't worry about shoulders so much, but it's knees or hips. 1 knee, 1 hip, two knees, no hips, whatever. As soon as you get that third weight-bearing joint, a lot of companies won't take it, because they know down the road, if the arthritis is that bad, it's crippling, we're gonna have a claim soon. And so that's become another sticky wicket. How bad is the arthritis?
From the VA side of things, I'm with James Cerebral Palsy Foundation, and from the VA side of things, when somebody is diabetic, like you were talking about before, and they're taking insulin and oral, what do we do as far as the VA side of it to find out what?
You want to call up a VA intake rep and ask them, give them your number, your DD-214 and everything, and ask them what my benefits are. So down the road, if you need help with home care, they give you 6 months of home care at 25 hours a week, and then whether they can put you in a VA facility. Now you want to get on the waiting list. I tell this to a lot of veterans who don't have any health problems, but they have a high income. We don't have enough VA rooms in the United States. So you have to use an income qualifier. And if your household income is over 49 grand a year, and you don't have a disability of over 50%, you have preference points, you basically will never get in the facility. In fact, retired Navy captains call me up, their pension's way over. There's no way they'll ever get in the VA facility. Because income's a big qualifier. We've only got 440 beds in Chula Vista. When they did the Agent Orange qualification from Vietnam, everybody was pushing to get to 50%. There were 35,000 beds in San Diego County that have 50% or better from the Agent Orange alone. There's only 440 beds down there. So they have to use some kind of way to balance out who gets in and who doesn't. So income qualifier is another one.
So is there a way for me as a nonprofit to get VA, the information you're giving from VA?
Yeah, call up the VA intake people and talk to a representative and give them all the information who you are, and they'll send you out what your benefits are, and they'll be able to tell you how you can get benefits. But you might want to get on the waiting list in case you ever got to go to a facility. And sometimes it might take 6 months to 9 months to a year. The waiting list.
Well, I was talking about resources that we can use as a nonprofit for people with disabilities that.
Now, you have to ask them on that, what the VA is willing to work with the nonprofit. I think they just work one-on-one with the vets. I don't think they come into a group environment. Each vet has to qualify individually.
I understand that. What I'm getting at is from our nonprofit, we do VA as well. So what would I do to contact VA to get?
That I don't know, because I'm in the private long-term care arena. But I've talked to veterans who have called the VA, they always call the intake person.
Okay,
And you want to go down there, you can even call them down to VA homes. They might have a person on staff that coordinates that, they can direct you to the right person.
gotcha. Thank you very much.
Yeah,
We got a question right
well, yeah.
So someone has like a knockout condition, a condition that would not qualify them to receive the benefits, like it's, so you mentioned that someone's taking, they're type 2 diabetic and they're taking insulin, they wouldn't qualify.
There's
Okay.
very, very real chance. They have to be under 50 units, no complications, a lot of things.
So
going
if
on.
they were able to reverse a condition, it wouldn't allow them to qualify. If they reverse that condition, could they qualify, or is it because they were diagnosed in the past and they're done?
No, if you reverse any condition, they have to usually go a period of time. Diabetes might be 2 years.
Okay.
For instance, we had an issue with hepatitis C, and Harvoni came out. That was considered the drug of the last decade, between 2000 and 2009. You give someone a drug and it was 96% successful at the end of 90 days, completely eradicated hepatitis C out of your liver with no trace. I went to a meeting, I said, oh, this is garbage. This is hocus pocus. This is like looking for Elvis. It's an Elvis diet. This is never gonna happen. I looked at this and my friend by me goes, this is a joke. And it worked. It's worked. So if you've been on Harvoni, it goes a year and you go back to your internist and they do follow-up test in your liver and it's gone, we'll take it without even a higher price either. Middle price, no add-on. There's stuff like that happens. The arthritis is another one. If you don't have a lot of joints replaced, but it's bad rheumatoid, and we get the rheumatoid knocked down, we're off the prednisone, methotrexate, or some of these things, and we get the inflammation down, it's manageable. We can take those people now too. Just depends on how far along it is. Any questions, thoughts?
Okay, we got one last question here.
Brad, during a claim,
Uh-huh.
how are premiums handled, especially if you've got more than one family member on the same plan?
Well, you have each family member would have to qualify themselves. So the person who's sick, that premium goes away when you're using the policy. It's like my wife and I have coverage. If I get sick, she's still paying her premium, but I'm off claim. I'm on claim using the money. I don't pay premiums anymore. And that's not just what I offer, that's the federal law. They're all that. Every one of them's that way. It's kind of a unique thing. The law, some people thought at the time, would strangle the industry. It set up standards for the industry that have been very good. I do lots of claims. I never get fought on the claim. When the doctor signs it's a claim. Our big question for so many people is, what kind of care do you want? Because we're going to give you a lot of money at a monthly basis. You know how to handle the money. If some of your family can deal with the money. Do you know what level of care you want? You know what you want in a caregiver. Now with my dad, he's not a picky eater. So he had a decent cook. She was there at the house. We wanted someone that could talk to him. The first one we had, she was a good cook and she wasn't social. That didn't work for my dad. So 4 months later, we traded her out. Then we got a woman that was a pretty good cook, would talk his ear off. He had all kinds of fun. He wanted to be entertaining. And he had guys coming over from the VFW. My dad parents were at Lakeside. And on Wednesday, sometimes she'd make lunch and they all sit around and talk about their Vietnam experience. My dad was a combat veteran in Vietnam. The apocalypse now boats. It just depends on what you want. I get calls from people. I said, you have to have a family meeting to determine what you want here. Because we'll go ahead and pay for it. I don't know what you want. And everybody has a different view of what home care looks like. Where it gets weird is when someone's got pets. They're not set up to take care of your pets. You can't take your dog to a vet. That's not home care. They can't do this stuff. They can't do your yard work. They can't call up the guy, get your car service, take it down, get your transmission back. They don't do that either. So there's a limit what they can do.
But they do invoice the service. They don't send a check directly.
Now, here's what happens. You get two ways to handle it. With my dad, we went ahead, we call that assign the benefit. So the agency would bill the insurance directly to John Hancock. And John Hancock would cut the check and send him $6,000, whatever it was. And they just wire it to them, wire the bank account. Who's at a facility, we wire the money to them. So you can set up either way. Either you can pay them and seek reimbursement or have the agency. Now in California, everything's regulated. It's all licensed. And all the places that are licensed can do billing for insurance. They can bill. In some states, they're not licensed. It's a little weird because you got to be licensed to bill insurance. And usually these places are owned by nurses, and nurses can bill. They can set up a billing because they have a nursing license. If they're unlicensed, they can't bill. So in that case, you have to pay for the services and have the insurance company reimburse you. Everything in this state is licensed.
Brad, thank you very much for your.
Thank you very much for having me. Thank you.
Thank you. Please come back. I'm sure there was a lot more questions.
Thank you, Brad, for sharing with us on long-term health considerations. We'll be posting the replay on YouTube, so if you weren't able to take notes, we'll even see what we do about maybe getting a copy of the handout on the website for download. So if you guys didn't get a copy, we'll be able to go to the website and access that. So really appreciate you guys all coming out. I'm gonna close this out in prayer and then let you guys get out to first service. So everybody bow their heads. Heavenly Father, we thank you for this opportunity to fellowship and to learn about a dimension of life that we should all be very cognizant about, our long-term health needs. We worship you as Jehovah Rapha, the healer, Father. We thank you for the healing that you've made available to all of us, your children. And Father, we ask that you would bless Brother Boswell as he goes about his business, Father, and helping those who need this service. Father, make him like a tree planted by rivers of water, where his leaf will not wither. He will bear good fruit in due season, and all that he set his hands to will prosper. Father, we ask that you would send legions of your healing angels with healing in their wings to infuse the bodies of those who need healing, Father. And we thank you that you have done so. We know that it has been already spoken of in your living words. We take hold of that promise, Father, and we stand on it. And we thank you in advance for the healing. Father, as we go about our week this week, we ask that you would bless us with your wisdom, your knowledge, your understanding. Give us the wisdom to know the right, the will to choose it, and the strength to make it into it. In Jesus' name we pray. Amen. Thanks, Brad. Thank you. We will see you in 7 exciting days. Blessings on you as you go.
No Easter class, no Easter service
I
class.
apologize. Sorry. It is Easter in 7 days, folks. I almost forgot about that. We will be taking a break for that week, so we will actually be back in 14 days here. So everybody enjoy the holiday, family, friends, whatever service you're going to. You're going out of town or anything like that, traveling versus on you to go. So we will see you in 14 exciting days. Yes, sir.
Quick announcement, I have a book coming out called The Libyan Amazons and the Conquest of Continents. And it's online, April 15th from Amazon. It's an exciting story, and I'm talking here on May 7th. I'll give you the Reader's Digest version, and it's a trilogy, so book 2 and 3 coming out. It's a story that's never been told. You're gonna love it. Thank you.
So it's the never-ending story.